Hello, my name's Nick Gardner. I'm the investment editor at the Association of Investment Companies, and I'm joined today by Jonathan Davis. He's the host of the very popular Makers podcast and editor of the Investment Trust Handbook. And I doubt if there are many people around today who have interviewed more investment trust managers and experts than Jonathan. So it's a great pleasure to have him join me. My first question for you today is, um, how did you first come across investment trusts?
Well, first of all, thank you for having me on this video. I'm delighted to be here. As you say, I've been around an awfully long time, for better or worse. And I first got interested in investment trusts way back in the 1980s, believe it or not, which was a very interesting decade for the investment trust industry. I was a financial journalist on the national newspapers, and investment trusts got back into the news again. They had become very sleepy and very depressed during the 1970s. It had been a very bad time for them. But in the 1980s, all sorts of things happened to the investment trust sector. We had consolidation, we had Black Monday market crashes, and we had the introduction of PEPs, the precursors of ISAs, for the first time. So it's been a long time, but I only kind of deepened my professional involvement in investment trusts about, 25 years ago, I guess. And I'm particularly credited to Ian Rushbrook, the former manager of Personal Assets Trust, the man who built that into the vehicle it is today, sadly died in 2008. A remarkable fellow, and he infused me with his passion for investment trusts. I mean, I've long been a believer in the fact that the if you're going to invest in managed funds, then investment trusts are a superior way to investing than in open-ended funds, unit trusts, and so on. There is competition now, real and effective competition from ETFs and other passive vehicles. I think one has to acknowledge that, and that's eroded some of the advantages of investment trusts. But there are many advantages for the investment trust structure, and we hear a lot about them. And there is validity, I think, some validity to all of them. So, for example, the ability to use gearing, the presence of independent boards, but most important one of all, I think, from my experience, is the fact that the fund managers do not have to sell things just because they have outflows or buy things because they have inflows. They have the flexibility to invest as they wish. And that is the reason, I think, the primary reason why the performance record of investment trusts, those that survive anyway, is on average superior to that of other open ended funds. I think that is the main reason. There are other factors as well. But I think relatively low fees compared to some open-ended funds, but that's dissipating now with the competition from passive and so on. But to me, that's the most important reason, and the independent boards, the second most important reason. Of course, like all these things, these advantages, they have to actually be implemented. It's not enough to have them; you have actually to do the work. And I think some boards have done better in that respect than others, as indeed some managers have done better with that freedom they have from the tyranny of fund flows. Well, I had actually I counted them up actually as I was preparing for this particular video, and the answer is I hold about 25 investment trusts, believe it or not. But that's spread across three different, so if you like, pots of money. I've got my SIP, I've got my ISA, and I also look after some family money as well. So across those trusts, I think we're about 25 in all, and there's a mixture. Obviously, as I got older, I have to have more regard to volatility and risk, and so I also own some gilts and so on. But looking through the investment trust list, I think they fall into a number of different categories. There's some global equity exposure. I have JP Morgan Global Growth and Income. A lot of people have that one. I have some Alliance Witten. I have some, what else have I got? I've got some AVI Global. Those are all three, I think, very excellent trusts that have performed well. I have some UK exposure, equity exposure, so the likes of Rockwood Strategic and Addition. I like that Harwood Capital stable, those two smaller company trusts. I also own merchants in the UK equity income sector, and I have some exposure to property as well. I'm a holder of AEWK REIT, for example, which is has the distinction of being the only commercial property trust that didn't cut its dividend during the pandemic. And then in terms of overseas exposure, I don't have any kind of general uh, global non-UK trusts or emerging market trusts. I'm not a particularly fan of those, but I do have some specific country exposure, so and regional exposure. So Fidelity European Trust, the actual stalwart of the European sector. I have in Japan. I like a Nippon Active Value Fund, one of the trusts that actually is pursuing corporate governance changes and takes a behind the scenes activist role with companies in Japan. There, that's done very well. I also own BlackRock World Mining for partly for portfolio management reasons. That hasn't done so well recently, but it's begun to pick up, and will tend to do well when some other equity trusts are not doing so well. And then I've got some other income generating trusts, so things like Greencoat UK Wind. I like Bluefield Solar. I'm still hanging on to those. They've started to perk up at last, but you have been paid a very handsome yield for the last 2 or 3 years. I've owned them for quite a long time. I sold some other uh, of those renewable infrastructure trusts when interest rates started to rise. Perhaps not enough of them, but I did. So I've also got international public partnerships as well. And then I've got I don't have much in private equity. HG Capital, I like Oakley Capital, which has tends to invest early stage in private equity companies across Europe, and also I have a holding in Literacy Capital. So those are the main ones I think that I have. There's obviously a very wide range of choice. More recently, I have taken advantage of the wide discounts in a couple of places to make a bit of money. I don't do much of that, fun enough, but Seraphim Space, I bought that at the lows. That's come back very nicely so far this year. And similarly with PRS REIT, which has obviously had some activism involved there, and they are considering the sale of their business under shareholder pressure. So, but generally speaking, I have to say, I am a buy and hold investor. I think with 25 investment trusts, it's a lot of work to keep track of all the things that are going on. So, yes, I've missed opportunities where, in theory, I could have made more money. But in general terms, I like to buy and hold. I do occasionally take advantage of big discount opportunities, but that's not the main reason, in my view, for holding investment trusts. You want to buy the good ones and you want to hold them for a long time. And the track record of most of these trusts that I own over 5 and 10 years, they have produced excellent results, well above the rate of inflation, which is, of course, your primary uh, objective as any kind of investor.